Wow, the Bank of Canada just cut interest rates for the second time in a row. That's amazing news. My name is Parm Rattan. I'm a mortgage broker here in Canada, and welcome to my channel. If you have any sort of financing questions, if you would like a second opinion, or if you would like to maybe buy your first home, a secondary home, investment property, or debt consolidate, you are in the right place. The Bank of Canada cut interest rates, and today we're going to talk about what that actually means. Now, simply, the Bank of Canada cut interest rates because our economy continues to struggle. So firstly, unemployment is up. In June, Canada lost 1,400 jobs, and as our population keeps growing and gets bigger and bigger, that unemployment rate is only going to go up because we simply don't have enough jobs. Secondly, consumer spending is down. Now, consumer spending represents about 60% of Canada's GDP, and many individuals are simply not buying enough stuff because they can't afford it. Things are too expensive, and consumer spending is sinking fast and drowning. Now, if rates were to go down, then consumers would spend more, which would boost up or ramp up the economy. And companies are actually also worried about this because they actually see or forecast slowing sales in the coming months. So consumer spending has taken a big hit, and our economy continues to struggle because of it. And lastly, inflation is down. Right now, inflation sits at 2.7%, and we are very close to the 2% inflation target that the Bank of Canada would like to see. Recently, it fell due to lower gasoline prices. Now, as inflation continues to fall, we will see further rate cuts by the Bank of Canada. Now, let's just say inflation is very aggressive and falls rapidly, then the Bank of Canada may need to panic and cut rates much faster. And how does the latest Bank of Canada news impact you? Well, if you are in an adjustable rate mortgage and a lender in this category is Scotiabank, an adjustable rate mortgage is where your payment actually goes up or down as the prime rate goes up or down. So in most recent news, the Bank of Canada cut rates, so your mortgage payment is actually going down. Now, if you are in a variable rate mortgage, and this is a mortgage product where your payment is static, it doesn't go up or down when the prime rate changes, your payment is not changing. And a lender in this category is TD Canada Trust. And what's going to happen here is more of your money or of your payment will now go towards principal and less will go towards interest. If you have any sort of balance on a line of credit, unsecured or secured like a home equity line of credit, your interest only payment is also going down because the way that lines of credits work is they are attached to the Bank of Canada prime rate. Now, the Bank of Canada prime rate announcement doesn't directly correlate with fixed rates. However, bond yields do get impacted from the news. So when the Bank of Canada cuts rates, it usually means bond yields will tumble or fall afterwards. And if bond yields fall, that means fixed rates follow. So when unemployment goes up or inflation goes down or the Bank of Canada cuts rates, that actually impacts bond yields. And every time bond yields go down, fixed rates follow. So recently we have seen bond yields go down, and they've been coming down over the past couple of weeks, and this is why we have lower fixed rates. And if this continues to happen and we see bond yields going lower and lower, especially after the next Bank of Canada announcement, if there is a rate cut, maybe 0.25 or 0.5, we will see lower fixed rates. Now, it won't be a drastic impact on fixed rates. It may take a month or 2 months to see maybe a quarter point decrease in fixed rates, but something is better than nothing, and that will result in individuals qualifying for more mortgage money, as well as lowering their monthly mortgage payments if housing prices don't go back up again. Now, future rate cuts are expected, especially if inflation keeps going down. Like I said before, our economy is struggling, and we need lower rates to ramp up the economy again. So if unemployment keeps going up, if inflation keeps going down, and consumer spending keeps going down, we will see future rate cuts, and we are expected to see more rate cuts later this year, and we're expected to see them by 0.25. But I have a gut feeling that the Bank of Canada may surprise us and may panic, and one of the announcements then may even decrease by 0.5%, but it's a very small chance of that. Now, the common question we always get is fixed or variable, and even right now, variable might be a good option, but it all depends on your risk. Right now, the spread between a fixed and variable rate is about 1%. So if you think that the Bank of Canada will be aggressive with rate cuts and you're okay with switching your monthly budget and going up or going down with the payment changes, then variable might be the option for you. If you would like no risk and you just want to be comfortable with your mortgage payments, you know what you're paying every month for maybe 2 or 3 years, then the fixed rate option is probably better for you, and especially if you are open to less risk. What does this mean for future demand? As rates continue to fall, we will see more people go from the sidelines and back into the market, and demand will surge upwards. We have a big supply problem here in Canada, and that will not get resolved anytime soon. And as rates go lower and lower, we will see more demand, and that demand is actually going to push up housing prices further up. We've seen this before in 2016, 2017, as well as 2020 and 2021, where we had lower rates. Many people thought it was the best time to get in because they qualify for more mortgage money and their mortgage payments are lower, but that led to multiple offers, subject-free offers coming back, and overall higher housing prices. If you are looking to get into the market and purchase a home, don't try to time the market, because if you buy high, that means you're selling high as well. It's kind of the same thing. Or if you're selling low, then you're buying low. So it's the exact same thing. Always buy a home and see if it's best to live in that home and create a plan to live in that home for at least 3 to 5 years. I hope this video answered a lot of your questions and gave you a better understanding of what the Bank of Canada announcement really was about. If you would like a pre-approval, a second opinion, or if you would talk about a current mortgage situation, feel free to book a free 15-minute discovery call at the link below. And don't forget to like, share, and subscribe to our channel. And we look forward to seeing you on our next video.